Hey traders, Nick Sheen here looking at how to use options to short a stock. This is specifically to somebody who likes to sell short stocks the typical way, not using options. So I'm addressing that because I have a few people in here that do that. And just a quick recap as to how shorting works in plain simple English. Usually, let's say if I wanted to short this morning, this is Zillow. This is a real example, and they actually shorted Zillow at the open, I think, or maybe prior to open, but today basically. So basically, you sell the stock, and what happens is there's a borrow against it. So in essence, you say to somebody, hey, give me your stock here, and I'll return it to you later. And so you take and you sell, you collect the money, then hopefully the stock will fall, then you buy it back to return the borrow at a cheaper price. The difference between what you sold it at when you borrowed it and the time you bought it to cover your short is your profit or loss. So in this case, they had a profit. So how could I do this without the, first of all, this is unlimited risk. So only you better have a good thesis while you're shorting, because if a stock gets bought out or just rallies to no end, then the amount of money that you could lose is unlimited in theory. Whereas if I buy the shares, my maximum loss is 100%. I can lose all of it, but nothing more. Whereas when I short a stock, I'm losing money for as long as the stock is rallying. So if somebody shorted Amazon at 50, they lost, and they're still short because they still think it's a bogus company. They're in a world of hurt. You lose money for as long as it rallies past the time you short it. So in this case, how could I have shorted it with a little more room to spare? So I took a snapshot of the options chains, and this is as of this morning. I don't know, it was already down 4%. So if somebody had shorted it, they made 4% on their short. In essence, I shorted it, borrowed it $2 higher than where it was, and then middle of the day, I decided to, hey, let me cover my short and book the profit. I buy it back for $44 and return the shares I borrowed. So the difference between, so I made $2 a share basically times the number of shares. Whereas, how could I have done that with calls? And this is the call side, this is the put side, and this is two different. I'm going to bring in a scratch pad. Two different expiration contracts. One expires in 3 days, so short term, and the other one is, I believe, 1 week. Yeah, 10 days. The eyes are tired. All right, so calls, this is the price of the call, the mark, the middle between bid and ask. So this is what they cost. So somebody that shorted the stock, they made 4%. Somebody that shorted the calls, they made this much. Why it's red? How come you're saying they made when it's red? That's because they sold it. So you sold the stock. It's red, so you're making money because you're short. So in essence, at the time, instead of shorting the stocks, I would sell a call. And if the stock was 46, I would have sold the call at 46 and collected almost $1 for it. Because then at this time, later, the price fell, and this value of $1 fell by this much. So I'm just estimating at the time they shorted it, it was $1. So the idea is, instead of shorting the stock, you promise to short the stock by selling the call. So if the price falls, then this call just gets obliterated in your favor because you sold it. So that's how I would make money. If I wanted to short it and don't want to short the stock itself, I can sell the calls. So how can I lose money? If the stock rallies, then I'm short starting wherever I sold. So if I sold the $46 call, then if the stock rallies, I'm short at 46. So if it goes to 50, I'm theoretically losing $4 a share, and they may call me on it and say, hey, you don't have enough money in your account to start. We're getting nervous. You better cover your short. How do I do that? I buy back that call for a lot more than 25 cents or a lot more than $1, which is what I collected to open it. It becomes superheated, just like these guys. Look how much the puts are heated because price fell into them, right? So, but if I had shorted the stock outright, I'd be out more money because it's the bigger dollar amounts that we're talking about when you sell the stock outright versus the calls. But the concept is the same. I'm losing. So options give you a bigger bang for the buck if you guess correctly. So if I guessed down and I made money, I would have made more on a percentage basis using call options by selling them or by buying put options. So that's a buffer. So how does that work longer term? This is too fast for my blood, shorting for the day, but it has its purposes. You can make, people do make a lot of money doing that, but it's too fast for my own taste. So what if I wanted to short Zillow with a little bit of meat on it, like a little bit of longer term? I'd say, you know what, Zillow was just, it's too expensive. It sells at umpteen PE. I don't really know. Oh, okay. It loses money. So I'd like to short it. And besides, this looks like a top of sorts. So let me short it with conviction. So what I'd do is I'd sell the call, but I'd give it time and distance. What does that mean? I take the bet a little further out in time. So it's not so much of an hour short or a day short. I want to short it real. So I'd say, you know what? I see this fail here. This looks like a top. And look, last time it happened, look how much it fell. Not to say it's going to happen again, but let's assume that this is what I'm assuming. This is my thesis for shorting it. Then I would sell the $50 call out in time. And for that, let me see if I can find, did I already download it? Okay, so this is a July, this is a July contract. And so it has 24 days on the clock. And I can short higher and collect more money without being directly in the line of fire. So in this case, I didn't take it high enough to show you the 50, but the concept is the same. So I don't have to short it where it is right now. I would short it higher and leave room for error. What does that mean? It means the stock can rally and I still can still win. All I need is for it to stay below my short. So if I short it, and I'm going to use theoretical here. Whoops, back to this one where I can mark it up. So if I short this one, let's say I collect $1 for it per contract. So if I do 10, that's $1,000 that goes into my account today. That's not mine until time ticks for another 20 days or so, and it stays below my, it can meander or do whatever it wants here. It could come up to it, maybe even go over it a little bit. And then the time expires and it's not here. It's a little bit lower. Then I keep the entire $1,000 as profit. All of it is profit. So what if it goes above it? Then my break-even point is $51. Why? Because I collected $1. Anything above $51, I own it. I'm short at 51. So if it's 51 and a penny, then I lost a penny per share. Not a big deal. I can just turn around and cover. So that's how using the call options works. So again, to recap, I can use options to bet directionally by buying a call to be bullish or buying a put to be bearish, or I can sell a call to be bearish and sell a put to be bullish. I've covered the selling puts many a time. I'll do it with some other stock. This is not a stock I sell puts on. So I don't typically like to sell naked calls. So you can sell a call spread and say, okay, it's not going to go above 50, but hey, you know what? I'm not comfortable taking more heat above 52, so I buy a call above it. So in essence, I turn it into a still a bearish call spread. So I want price to stay below it because I want to retain the money I collect. So I collected $1 to open this by selling it. I pay back, let's say 40 cents. I'm making up numbers here, in order to buy insurance above it and cap my potential losses. So if it goes to $1 million, my maximum loss is just the width of the spread minus what I collect. So plenty of ways to short and go long using the options. It just depends on the thesis and the time frame and all of that. I can do it intraday or go out a year and collect a ton of money. I'll give you an example. If I go out to October and sell a put for Amazon at, okay, 1,400. Where's Amazon now? 19. So if I go a weekly, all right, if I go to October and sell a put down here for Amazon, what does that mean? It means I commit to buying Amazon shares at $1,400. I can collect $8 per share, $800 per contract I sell. So it goes into my account. If I do 10 contracts, that's $8,000 goes into my account. But if Amazon falls through 1,400, my penalty is to have to buy it at 1,400. Okay, so that means it can fall 26% from current price. Then I start getting in trouble, and my break-even point is $8 lower because I collected $8 to open it. This today, what I just mentioned about Zillow is the opposite. Again, I'm not shorting Zillow. I'm just saying that I can short a stock by selling calls instead of selling the stock itself and have needing a whole bunch of out-of-pocket expense, or do it as a credit call spread, a bear call spread. It has many names. I basically want to sell premium above current price and wait for time to be my friend. Nick signing out. If you have any questions.